Hello, good evening, and welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. Welcome to another session of NCERT Fundamentals, wherein we are taking the chapters from the different NCERT books for different subjects, and we are discussing each of these chapters. And in today's video, we will have a look at one more very important chapter from class 12th, Economy, Macroeconomics. The name of the chapter is Money and Banking. And for those of you who will ask me specifically, sir, what is the title of the book, which standard it is, which chapter it is, please have a look at this. This is class number 12, Introductory Macroeconomics. That's the title of the book. And in this book, the chapter number 3, titled Money and Banking, we will have a discussion about the concepts which are mentioned in the chapter here. Now let me start with a very important basic concept. I'm pretty sure all of you heard of concept of barter system in the high school or in other, let's say, standards or somewhere else. You must have come across the term barter system. What do you understand by the barter system? Essentially, barter system is a system where the transactions are conducted between two parties, where one party, that is, let's say, person A, will sell a product, let's say X, to person B, and in return will get another product, let's say Y. And the concept of the barter system is that, imagine if A wants to sell, let's say, apple. If A wants to sell apple, he will have to find out somebody in the market who wants to purchase apples, point number 1. And point number 2, he also has to find out whether B has, let's say, whether B has cattle that A wants to purchase. Essentially, A wants to sell apples and in return purchase cattle. In the market, he has to find out somebody else, let's say person B, who wants to purchase apple and wants to sell cattle. This is essentially called as a barter system. And whatever I have told in the last 1 minute, in a technical sense, this is called as a diametrically opposite demands or wants. Or else there is one more technical term, double coincidence of wants. In essence, if we are there in the barter system, I want to sell something, you should want to purchase that. And in return, whatever you want to sell in the market, I should be wanting to purchase it. This is basically the concept of barter system. To begin with, in the history, we followed barter system because at that point of time, there was no concept of money. There was no idea or the concept of money. Money essentially, I'll give you a definition now. Money essentially is commonly accepted medium of exchange. Sir, what is the meaning of this? Let's take a very simple example. In today's situation, let's say there is a farmer who has cultivated apples, or let's say banana, or vegetables, etc. The farmer doesn't have to search in the market the one who wants to purchase, let's say, apple and who wants to sell cattle. No, the farmer doesn't require all of this circus to be done now. All that the farmer does is, will take the product to the market, sell it in the market, get the money, that is rupees, get the money. Now use this money to purchase cattle from the market. So essentially, what is the role of the money here? What is the role of the rupee here? The rupee, that is basically the money in India, will play an intermediary role, or it will act as a medium of exchange, where I will sell one product, in return I'll get money, and I will use this money to purchase another product. That is basically the concept or the role that the money plays in today's situation compared to earlier barter system. So in case of barter system, please understand the problems now. In barter system, we always had to find out the issue, or we always had to find out somebody who had diametrically opposite demands or wants. That is the problem of coincidence of wants. That was the first problem with the barter system. double coincidence of wants. Second issue with the barter system was the storage of value. That is essentially, please understand this. Today I have cultivated, let's say, certain vegetables. Now if I was there under the barter system, I might have to spend a lot of time, I have to spend a lot of resources to search somebody in the market who wants to purchase vegetables and wants to sell, let's say, a product to me that I want to purchase, such as, let's say, a cattle or a tractor, etc. That is a problem in a barter system, because the vegetables cannot be stored for a longer duration. Vegetables are perishable commodities. They will be spoiling very soon. The quality will be lost as well as the quantity will be lost. Whereas when you shift from the barter system to the money, that is a mode of exchange or a medium of exchange, what is the benefit? The benefit is that now I can simply sell the vegetables today itself. I don't have to search for somebody who wants to sell a tractor and sell the vegetable to them. No, I will sell the vegetables today, get the money. Now I can store the money. I can simply store the money. I can use the money after 1 month. I can use the money after 6 months. I can use the same amount of money after 3 months as well. But under the barter system, if you store vegetables for 3 months or 6 months, I hope you already know what will be the situation of this place, or let's say the container where you will be storing the vegetable for 3 months or 6 months. So money will act as a storage of value. That is the precise reason over a period of time, all of us have shifted from the concept of barter system used for buying and selling of commodities or goods or services in the market to the usage of money in the market. Now, whenever you use the term money, what are the functions of the money? It acts as a medium of exchange. Just now we have understood this. You can use money to purchase goods. You can use money to sell goods. Use the money in the sense you can sell the goods, get the money. You can use this money to purchase goods, etc. Second, money acts as a convenient unit of account. Essentially, it means whatever goods or services you want to purchase or you want to sell in the market, everything can be defined in terms of rupees. Everything can be defined in terms of money. And some of you, when I keep on using the term money, rupees, some of you will be confused. Some of you will basically say, sir, what is the difference between money and rupees? My dear, money is a very common term, umbrella term. And below that, there are different forms of money. One of them is rupees, that is the domestic currency that we use in India. Whereas if you go to USA, they will use a different form of a money, that is they will use dollars. If you go to other markets, you will find pound. If you go to other countries, you will find yen, yuan, etc. All of them are forms of money itself. From one country to another country, different type of money is actually used. So money will act as a convenient unit of account. That is, every good or a service you want to sell in the market, you want to purchase from the market, all of it can be defined in terms of money itself. For example, you want to purchase onion. Don't you think onion is defined in terms of money itself? That is, for every kg, how many rupees you will have to pay. You want to book an air ticket. Don't you think that is also defined in terms of rupees? That is money. You want to, let's say, order something on Swiggy. That is also defined in terms of rupees. So money will be used as a unit to, will be used as a unit for every product, every good or a service to define in that particular way. Next, money will act as a storage of value. Just now we have understood this. But apart from this, why do we want to hold money? What are the motives? Why do you want to have money? Why do I want to have money? What are the motives behind it? Generally, the motives behind holding money can be divided under 3 reasons or 3 causes. First one is called as a transaction motive. The first one is referred to as a transaction motive. What do you mean by transaction motive? You want to purchase goods and services. You want to recharge your mobile number. You want to purchase onion. You want to purchase, let's say, food from the market. You want to purchase a metro ticket. For all of these reasons, you should have money. For conducting transactions, money is used as a mode of exchange, a mode of a payment. That is the one reason why do we hold money. So first motive is a transaction motive. Second motive is speculative. Second one is speculative, that is speculation. So what is this idea of a speculative motive? Imagine you have certain amount of money. You want to invest this money in the market, let's say in government bonds. So obviously, to invest in the government bonds, you should have certain amount of money or cash in your hand. Whenever the government bonds will fall down, the prices of the government bonds will come down, you will use this money to invest in the bonds so that you will be able to hold the bond. When the prices will go up, you will sell the bond, earn money. That is essentially, I will use one term which is there in the newspaper very often in the last 1 week, the concept of capital gain. The concept of capital gain, essentially meaning you will invest money, purchase an asset, you will sell the asset when the prices will go up. So the difference between the price at which you have purchased the asset to the price at which you have sold the asset, that is called as a capital gain. So one of the reasons or one of the motives of why people would want to hold on to the cash, why they would want to hold on to the money in the market is because of speculative motive. That is, in a nutshell, they want to use the movements in the market, that is the price movements of certain assets such as, let's say, the government bonds or bonds generally, to invest in these instruments and earn money. That is the second motive, speculative motive. And the third very important motive is precautionary motive. What do you understand by the term precautionary motive? Now please understand this. I am pretty sure all of you have wallets. Now if you open your wallets, I am 100% sure here, there will be one, let's say 100 rupee note or a 500 rupee note that you will fold very nicely and store it in a secret compartment. I hope you understand. Now some of you will say, no sir, I don't do that. Ask your parents, especially ask your mother. She will tell you that some of the cash that is there with her, she would be simply storing in a very secret place. Very secret place. It could be in an, let's say, the cupboard where you keep clothes, or it could be in one of the boxes where you keep the groceries in the home, etc. And if you ask her, what is the logic behind it? What is the reason behind keeping the money in that particular form? Because if you keep the same amount of money in an FD, let's say in a bank, obviously you will be earning certain rate of interest. Your mother will tell you, or even your father will tell you, we have to keep certain amount of money in the form of a cash because there could be certain emergency. Correct? They'll simply tell you, and I'm pretty sure all of you know this as well by now. There could be a certain emergency, and if there's a sudden emergency and you need cash, what will you do? Can you run to a bank, close your FD and withdraw money? That will take up some amount of time. And what if the bank, the timing of the bank is already over and you don't have a mobile bank account, etc. So that's the reason, please understand. The third motive, why do we keep cash with ourselves? Why do we keep, let's say, money with ourselves? The third motive is a precautionary motive. So first one is a transaction motive, second one is a speculative motive, and the third one is precautionary motive. So these are the three very important reasons. Please be very careful. The next term that is used in this textbook, or let's say the chapter, is the concept of fiat money. You'll come across the term fiat money, and also you will come across the term legal tender. Let me explain both of them to you. What do you understand by the term fiat money? One is fiat money and the second one is legal tender. The idea of fiat money is very simple. Earlier, if you remember, I said there are different forms of money. money is available in the market in different forms or in different ways. The money that you have in the form of a currency coin and a currency note. I hope you understand. The money that you people have in your wallets or in your purse right now, either in the form of a coin or in the form of a note, that is essentially called as a fiat money. Sir, what is this fiat money? Fiat money essentially means the money, the value of which is given, guaranteed by the government. The government through an order will give certain guarantee for currency in the market. Otherwise, please understand, it is simply a piece of paper. I hope you understand. It is simply a piece of paper. Let's do a very simple exercise. I hope everybody can see this. I have a 100 rupee currency note in my hand. 100 rupee currency note. Somebody might simply say, sir, why 100 rupee? Why can't you show me 2000 rupee note, etc.? My dear, I don't have so much amount of cash right now. So let's say this is 100 rupee currency note. This piece of paper will have a value of 100 rupee in the market precisely because of government order. If tomorrow Government of India announces through a notification, the government announces that this 100 rupee note henceforth in the market will not carry any value, then my dear, this is just a piece of paper, worthless piece of paper. If I just want to give you a context in this, all of you remember what happened in the year 2016 when the government announced demonetization? What do you understand by the term demonetization? Monetization essentially means giving value to something, and demonetization means withdrawing, removing or taking away the value. So government announced the 500 rupee notes as well as the 1000 rupee notes, their value will be taken away. The value will be taken away, which essentially means once it is done, and let's say the same cases or same thing happens in case of this 100 rupee note, then this is simply a piece of paper. That's it. It's simply a piece of paper, worthless piece of paper. It doesn't have any value in the market. Just to make it abundantly clear to all of you, imagine you're cleaning, you're removing your books, you're cleaning your table, you're removing your books from one side to the other side. Suddenly you find one old 1000 rupee note. The old 1000 rupee note, the red colored 1000 rupee note. My dear, now tell me, even though the paper has 1000 rupee written on it, RBI governor's signature is also there, can you take that piece of paper in the market, try to purchase goods and services? Nobody will accept that as a currency in the market because the government has withdrawn the value. There is no value ascribed or given to this piece of paper now. So whenever you come across the term fiat money, please understand, fiat money essentially means the money, the value is given by the government. That money has value because the government order is there. If there is no government order, absolutely no, that paper cannot be accepted as money in the market. So currently, all the paper notes that you have, that is again the new 500 rupee notes, 2000 rupee notes, 100 rupee, 50 rupee, 20 rupee, 10 rupee, even the 5 rupee coin, 10 rupee coin, 2 rupee coin, all of these are basically called as fiat money. Now in addition to this, there is also one more term called as legal tender. What do you understand by the term legal tender? Please understand, the money that can be used to settle certain debt. I repeat, you owe certain amount of money. You imagine you go to a shop and you purchase certain goods and services. Can I simply say you owe certain amount of money to the shopkeeper? So whenever there is a certain amount of debt that you have to repay, whenever you owe certain amount of money to somebody else, what money can be used to pay off that? It is called as a legal tender. It is referred to as a legal tender. And the government through notification will simply say which can be used as a legal tender, which cannot be used as a legal tender in the market. For example, imagine you go to a shop, you purchase the new iPhone. Let's take a simple example to make you understand. Imagine you go to a shop, let's say a Chroma or Reliance store, and you want to purchase new iPhone, newly launched iPhone, and the highest storage value or storage space as such. Let's assume, I don't know what is the exact price, do not worry about it. Let's assume the price is 2 lakh rupees. Now my dear, can you simply take out your checkbook, write a check and pay 2 lakh rupees in the form of a check payment? Please understand, whether the check will be accepted as a mode of payment or not will be decided by the acceptor, that is the store owner, not you. Because the check is not a legal tender, the currency notes are a legal tender. Instead of the check, imagine if you take out your debit card, ask them to withdraw money or debit the money from the card, they will accept it. You take out your credit card, they will accept it. You will pay in the form of a cash, they will accept it. So I hope you understand, the legal tender essentially means what kind of money can be used to make payments whenever you owe the money. That is called as a legal tender. So these are certain very important basics that provide you a lot of information regarding what is money, why there is a demand for the money in the market. Now let's try and understand how the money is supplied in the market. How the money is supplied. So because there are two sides to a transaction, demand as well as supply. So far we have understood the concepts regarding the demand for the money. Let's understand the supply of money. In the context of supply of money, please understand there are two important financial institutions. There are two important financial institutions. One is Reserve Bank of India, RBI, which is playing a very important role to supply or to ensure how much money will be supplied in the market. In addition to Reserve Bank of India, we also have commercial banks. And the commercial banks will also play a lot of important role or major role along with the Reserve Bank of India to ensure how much money is supplied in the market. Let me start with the role of RBI here. Reserve Bank of India, using multiple instruments such as open market operation, bank rate, lender of last resort, etc., will ensure sufficient money supply is there in the market. And when I say sufficient money supply, please understand, it all depends on whether Reserve Bank of India wants to control the inflation now or RBI wants to promote growth right now. Because whenever RBI wants to promote growth, RBI will increase money supply so that the interest rates in the market would be lower. And on the other side, if RBI wants to control inflation, RBI will try to reduce the money supply so that the interest rates in the market will go up. So based on the task at the hand, based on the objective right now, RBI will use multiple tools either to increase or decrease money supply using the banking system in India. For example, open market operations. What do you understand by the term open market operation? Under the open market operation, Reserve Bank of India will either sell government bonds or buy government bonds. I hope you understand. Under open market operation, Reserve Bank of India will either sell the government bonds or buy government bonds. What is the objective? RBI will sell government bonds whenever they want to control inflation. Because if RBI will sell government bonds, it will take away the money from the market. Let's say you are the RBI governor. Be happy now, you are the RBI governor. I am a bank. You as a governor, you feel there is too much of money supply in the economy and that is contributing to inflation in the market. So what will you do? You will sell government bonds to me. I will give money in return to you. And when this happens, money supply will automatically come down and that will help in controlling inflation. And under open market operation, there can be opposite side as well. That is, you want to promote growth. So what will you do? You will purchase government bonds from me. I will sell the government bond to you. You will give the money to me. Again, same example. You are RBI and I am a bank. So when I will sell the bond, I will get the money. Money supply automatically increases. That will help in promotion of growth. Now please understand, under open market operation, there can be two types. One is called as an outright open market operation. Outright open market operation. And the second one is called as a repo. Repo is basically a type of quantitative type of a tool. Right? In case of outright open market operation, please understand the difference between both outright and repo. Under outright, RBI will, let's say, simply sell government securities. That's it. Will simply sell government securities, one-sided transaction, or will simply purchase government securities. Right? There is, let's say for example, if RBI will sell government securities, that's it. The transaction is over. No promise of, right, any other transaction. Whereas there is one more concept called as repo, and just now whatever I explained, that is basically called as an outright OMO. Outright. Whereas in case of repo, let me give you a very basic example here. In repo, what generally happens is, repo stands for repurchasing order. Repo stands for repurchasing order. Right? That is repo. In repurchasing order, what generally happens is, here is a Reserve Bank of India and here is a bank. Okay? Let's say any bank, for example, State Bank of India. Under repurchasing order, RBI, right, this is the transaction that will happen. RBI will provide money to the bank and the bank will basically sell government securities to RBI. Let's take a simple example. 100 rupee worth of G securities sold by the bank to RBI and RBI will transfer 100 rupee to bank. But when this will happen, this is a step 1 or leg 1 of transaction. When this will happen, there is a contract, there is an agreement between both RBI as well as SBI. Under this agreement, RBI as well as the bank agree that after this step 1, that is the first transaction is done, after let's say 1 day or after 7 days or after 14 days, exactly opposite transaction will be conducted. What do you mean by exactly opposite transaction? Under step 2 or the leg 2 of the repo transaction, here is RBI. RBI will return the government security to the bank, that is basically sell the government security to the bank, and the bank will pay 100 rupee plus let's say 10 rupee to RBI. So the step 2, whatever transaction is going to happen under step 2, that is already recorded in the agreement. That is, the State Bank of India is telling Reserve Bank of India, today you purchase this government security, give me 100 rupee. After 1 week, I will repurchase the government security at 110 rupees. And right, basically you can transfer the government security back to me. So whenever these kind of transactions are happening, that is when the transaction is done, there are 2 parts. Not just one-sided transfer, there are 2 parts to the transaction. Today you sell the asset with the promise of repurchasing it. That is called as a repurchasing order. This is essentially called as repurchasing order. And if you just calculate the interest here, if you just calculate the numbers, on 100 rupee the bank is paying 10 rupee, which essentially means the bank is paying 10%. So this 10% is called as repo rate. This is essentially called as repo rate. So I hope you understand, in case of repo, there is a rate of interest calculated this way. But more importantly, in outright, RBI will, let's say, purchase government securities and give money. That's it. That happens in the outright OMO. Whereas under repo as well as the reverse repo, there are 2 sets or 2 legs to the transaction. First part of the transaction, asset will be sold. Second part of transaction, after certain number of days at a specific price, at a certain price, the asset will be repurchased. That will happen under repo as well as reverse repo. Now, if you have understood repo, reverse repo is exactly opposite. That is, under step 1, RBI will sell the government security to the bank and collect money. In the step 2, RBI will pay money along with interest to the bank and the G security will be given back to RBI. That is basically reverse repurchasing order. So one is open market operation, under which there are two types again, outright and repo as well as reverse repo. Reverse repo and repo are generally discussed as a part of quantitative set of tools. Second one is a bank rate. What do you understand by the term bank rate? Under bank rate, please understand this. RBI will provide loans to the banks, scheduled commercial banks. RBI will simply provide loans and charge a rate of interest. That is called as a bank rate. Now, some of you will say, sir, it is same as repo. My dear, bank rate is purely a lending rate of interest, whereas repo is a repurchasing order where assets are sold with the promise of repurchasing after a certain number of days at a specific price. That's a very important difference between a bank rate as well as a repo rate. Lender of last resort. RBI is also referred to as a bank of last resort, banker to the banks. And the context of lender of last resort is, whenever a bank is working, there might be emergency. The bank would want certain amount of money because they have certain emergency. There is a dire need for the money. So in such situations, the banks can always approach Reserve Bank of India and borrow from Reserve Bank of India. That's the reason RBI is referred to as bank of last resort. Now regarding qualitative and quantitative, already I have told you. In quantitative, please understand, the most important policy tool is a repo. Most important policy tool is a repo. And all the other interest rates are generally connected to the concept of repo rate itself. And whenever repo rate is changed, all the other interest rates will also change accordingly. What about qualitative? Qualitative essentially means we can target a specific sector and change the money supply in the specific sector. For example, under qualitative, there is a tool called as Priority Sector Lending, PSL, Priority Sector Lending. What is the meaning of the term Priority Sector Lending? And PSL is a part of concept called as rationing of credit. And those who are wondering, sir, what do you mean by rationing of credit? Rationing essentially means distribution. I repeat, rationing simply means distribution. Now, how the banks will distribute their credit, that is called as a rationing of credit. Under rationing of credit, that is Priority Sector Lending tool, RBI mandates that all the banks in India will have to ensure that at least 40% of the credit issued in 1 year will have to go to specific sectors. For example, agriculture, the student or that is education loans, MSME, micro, small, medium enterprises, export credit, weaker sections of the society, housing, etc., etc. Totally 8 areas are covered under the concept of priority sector lending. Now just think of it, if I change how much of the percentage should go to agriculture sector under PSL, don't you think only we are targeting agriculture sector and we are changing money supply in agriculture sector in the form of loans given? So that's the reason the qualitative set of tools are also referred to as specific tools, right? So the quantitative are called as a general set of tools and qualitative are called as specific set of tools. So these are the ways through which Reserve Bank of India as well as commercial banks will regulate money supply in the market. So one side we discuss the concept of a demand for money and on the other side supply of money. Now whenever you come across the term total money supply, what does it actually represent? It represents a total stock of money in circulation among the public at a particular point of time is money supply. That is how much is the total money that is being circulated in the economy amongst the public. That is essentially called as total money supply. And the money supply in the economy is regulated by Reserve Bank of India by using repo, reverse repo, bank rate, OMO, quantitative as well as qualitative set of tools. And finally, there is one concept called as a money multiplier. What do you understand by the term money multiplier? Money multiplier essentially means Reserve Bank of India, by using tools, various tools, will try to regulate money supply. That is either increase money supply or decrease money supply. But let's say RBI will print 100 rupee and supply this 100 rupee in the market. What will be the total amount of money that would be there in the market because of RBI printing and issuing this 100 rupee? I hope you understand. What is the maximum money supply that is possible with introduction of this, let's say 100 rupee? That is called as a money multiplier. How much is the change in the money supply when monetary base or money base is changed? Let's say RBI will print this 100 rupee right now and will supply this 100 rupee into the banking sector. Because of this 100 rupee, what is the total amount of money that is going to change? That is the supply that is going to change. That is basically called as a money multiplier. Now some of you will basically tell me, sir, if RBI will print 100 rupee, total money supply will change by 100 rupee. What is so different in that? What is so logical in that? My dear, it's not correct. Reason being, please understand this carefully. If I simply deposit this 100 rupee, imagine RBI has printed 100 rupee, I have this 100 rupee. If I deposit this 100 rupee in a bank, banks will use this 100 rupee to give loans in the market. Of course, they cannot use all the 100 rupee because they will have to keep certain reserves to take care of certain interest. So whatever is left out after reserves, they can use this to lend in the market. So when they will lend in the market, the total amount of money supply will increase because the loan issued by the bank is the new money that is created, loan that is created. Please remember this. In this example that I gave just now, the bank is not printing money. I hope you understand this. The bank is not printing money. The bank is merely collecting deposits from the people and giving loans. This loan that is issued by the bank, that is the debt that is created right on me, on you when you take a loan or when I take a loan, this is essentially type of a money. This is called as a commercial bank money. And whenever RBI calculates the total amount of money, they will count even this particular credit as well. Right? So that is the reason the total money supply will change with RBI printing and issuing money or supplying money in the market. And the money that is printed and issued by RBI is referred to as monetary base. With monetary base, the total amount of money in the circulation also changes. So these are certain very important things or the concepts that are given in the chapter 3 of class 12th NCERT Macroeconomics, Money and Banking chapter. Now based on this, what kind of questions have been asked in the past? I'll discuss 2 questions and 1 question, it's an assignment for you. You will have to tell me the answer. Previous year question 2022. With reference to Indian economy, consider the following statements. If the inflation is too high, Reserve Bank of India is likely to buy government securities. Just think of it. If inflation is very high, RBI will purchase government securities. Don't you think money supply will further increase, causing more inflation? First one is wrong. In fact, when it was asked in 2022, we could have used elimination. Let's use it, but I'll solve the question as it is with all the 3 statements. One is wrong, so obviously C, D and A are wrong. But anyways, let me solve the remaining 2 statements. If the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. My dear, some of you will basically say, sir, you did not discuss the concept of role of RBI in rupee depreciation. There is one more lecture that is already uploaded in the same channel, concept of balance of payments. And in the concept of balance of payments, I think I've discussed this idea. What is the role of RBI? But anyways, if the rupee is rapidly depreciating, RBI is likely to sell dollars. Yes, absolutely correct. Because by selling dollars, RBI will increase the supply of dollar, reduce the supply of rupee. And when you reduce the supply, the value fall or the depreciation of rupee will stop. It will become stable. Second statement is correct. If interest rates in USA or European Union were to fall, that is likely to induce RBI to buy dollars. Yes, understand the logic here. Statement is true. If interest rates in USA will fall, foreign investors would bring lot of money into India. And when they will bring lot of money into India, the supply of dollars in India will increase. RBI will start purchasing dollars from the market. So second and third are true. Right option for this question will be 2 and 3, option B. Second question, which was asked in 2021, consider the following statements. Governor of Reserve Bank of India is appointed by central government. Yes, absolutely correct. Certain provisions in the Constitution of India give the central government the right to issue directions to RBI in public interest. Under Constitution of India, absolutely no. Right? There are no provisions under the Constitution of India regarding Reserve Bank of India which will give the power to Government of India to issue directions. Absolutely no. But under RBI Act of 1934, yes, there is a provision. The Governor of RBI draws his powers from the RBI Act of 1934. This is also true. Whatever are the functions of RBI, whatever is the composition of RBI, whatever is the roles and responsibilities of RBI Governor, all of it will come from RBI Act of 1934. So first is correct, third one is correct. Right option will be option C, 1 and 3 only. Now this is your assignment. If RBI decides to adopt an expansionist monetary policy, expansionist means increasing money supply. Very simple. Expansionist means increasing money supply. If RBI decides to adopt an expansionist monetary policy, which of the following RBI will not do? And this question was asked in 2020. Which of the 3 statements are applicable here and which is the right option? Please do let me know in the comment section below. So that's it from my side regarding this chapter, that is chapter number 3, Money and Banking from class 12th NCERT. If you like these initiatives, hit the like button. And if you yet to subscribe to our YouTube channel, kindly do it now. Thank you. Have a great day.
NCERT books are unavoidable to crack the IAS exam. Not only is the content of these books authentic, but these books also help a civil services aspirant to build conceptual clarity. And most importantly, lots of questions in the civil services examination are directly asked from NCERT books. But the aspirants often find it difficult to cover these books, or worse, they even end up ignoring these books. We at Unacademy IAS English are going to make the reading and understanding of the NCERT books easier. We present NCERT Fundamentals course, a free initiative of Unacademy IAS English. What are the highlights of this program? Comprehensive coverage of the most relevant NCERT books for the civil services exam. Prelims and mains practice questions in each session to test your understanding of the fundamental concepts. This course begins from 12th of July every day at 6 p.m. right here on our YouTube channel. Subscribe to the channel now.